Thank you. This is Gene Goldman. I'm the Chief Investment Officer for Cetera Financial. Welcome to my presentation. Equity markets are a little bit ahead of themselves. So I'll talk about what this means in a second, but let's just kind of take a step back and look at what an interesting year we've had. First of all, the S&P 500, as you see here, is up about 16.9% for the first half of the year. Basically, it's the best first half since 2019. Nearly all asset classes, with the exception of commodities, were actually positive. So basically, everything in the market did pretty well. Last year, the laggards that hurt the market, so like technology and growth, they're actually doing well in the first half of this year. So it's a very strange market. So as I said before, everything has done well in the markets for the most part. But that said, it's been a very interesting market. Large cap growth, those big growth companies like technology companies, they've outperformed dramatically over large cap value. Technology is up about 29% for the first half of the year. Large cap value, these are companies like banks, like industrials, like basic materials, very economically sensitive companies are up only 5%. So it's a very, very strange market. And then last but not least, large cap, those big companies are outperforming mid-sized companies, which are outperforming small companies. So it's a very strange market. And this is important in terms of when we talk about positioning and portfolios a little bit later, and diversification, of course. So with that said, beginning of this year, we laid out three themes in our 2023 market outlook. We said, number one, the Fed may pause. We'll talk about the Fed, of course. They may pause, may even pivot a bit. That means they may go from raising rates to slowing down rates to maybe even cutting rates. Our second theme at the beginning of this year was upside surprises would be possible. What that means is that so much negativity and pessimism in the economy, the markets would weigh on economic data. Basically, you'd have lowered expectations that become easier to beat. And our third theme was that market volatility would increase dramatically. If we kind of look back to say, how did we do? Well, two of the three themes I think panned out well. Number one, the Fed is pausing. I'll talk about that again, what that means a little bit later. Second of all is that upside surprises have occurred. They occurred a little bit earlier than we had anticipated, but they did occur, and I'll talk about why in a second. And third of all, we really didn't see much market volatility. So as we kind of look towards the second half of the year, we're still keeping our themes, but we're tweaking them a little bit. Our second half themes are as follows. Number one, the Fed will pause, and the Fed has paused. I'll talk about what that means in a second, but they will maintain a higher for longer risk. That's very important. Second of all is the equity market, again, having one of its best first halves in a long time, may have gotten a little bit ahead of itself. Maybe the equity market has said, you know what, we're ignoring all the headwinds and the concerns in the market and just powering through. Third of all is that even if we have any type of volatility, even if we have a market pullback, we're setting ourselves up for a better market foundation. We do expect late this year and next year, the foundation in the market to be extremely good. So three themes for the rest of this year. So let me dive into the first one. And the first one is, again, the Fed is likely to pause, but maintain a higher for longer perspective. You look at this slide, and I showed this to you last year, but last time we spoke, this slide is so very important. This is the Fed funds rate. And remember, we talked about this, the Fed, short for the Federal Reserve. They're in charge of monetary policy, and they have two mandates. Number one, they want to make sure we all have jobs. And number two, they want to make sure that inflation is kept in check. So the job market is pretty strong. Unemployment rate is near mid threes. It's a very good employment market, but inflation still remains pretty elevated. So you look at this chart, the primary tool is called the Fed funds rate. They raise it to slow the economy down because this increases borrowing costs. And if the economy is going too slow, and we aren't all having jobs, they lower the Fed funds rate, and this reduces borrowing costs, and in theory, people spend more money. You look at these two arrows, the Fed has been extremely aggressive. The first arrow shows the last rate hike cycle from 2016 to 2019, went from 0 to 2.5% in 3 years. It's a pretty quick move by the Fed. This current cycle, the second arrow, is the Fed has gone from 0 to 2.5% in their primary interest rate in just 6 months. The Fed has been extremely aggressive. Again, aggressive because they are trying to slow down inflation in terms of the inflation in the economy. So you look at the fact that the Fed recently sort of announced a pause. And what happened was that basically in the June Fed meeting, and the Fed meets a few times each year, but the June meeting where they set interest rate policy on a go-forward basis, what the Fed did is that they paused. They didn't raise rates, but they also did what's called a hawkish pause, where they said, we are going to likely raise rates a little bit later in the year. So it's a very strange thing the Fed did. They paused. They said, we're not going to raise rates in the June meeting, but we're going to raise rates later in the year. And again, I'll talk about that in a second. So pause. Why did the Fed pause? And then really the pause was driven by inflation optimism. Because remember, the Fed raises rates to slow down inflation. But you look at this chart. This chart shows CPI, the Consumer Price Index, over the last 3 months, 6 months, and 12 months. And you see the red arrow. It's rolling down pretty quickly. The Fed is doing a good job. They're coming out, they're raising rates, and they're reducing the effects of inflation. That's good news. That's the pause. That's the pause that we've seen the Fed. They paused in the June meeting. But for you, you're saying, okay, I understand the pause, but Gene, why are we saying higher for longer? Why do we think the Fed will keep rates higher for longer? Because usually the Fed pauses and the next step they start to cut rates because they're going to stimulate the economy. Why higher for longer? This slide says it perfectly. This slide shows inflation. Remember, we've been looking at inflation, the last slide. We're looking at inflation in a different way. We're breaking out inflation into two components, services inflation and goods inflation. The goods inflation is that dark purple line. And you see goods inflation, like inflation for refrigerators and bikes and textbooks, has rolled down pretty fast. The Fed has done a great job by raising interest rates, increasing borrowing costs, the economy slows down. What's not been coming down is services inflation. This is inflation that you see at bars and restaurants and basically anything around services. Hire a plumber, service inflation is much higher. And you see that light blue line, that's services inflation. It has not rolled down. It's been very, very stubborn. The Fed is worried about this. They're worried about that stubborn services inflation. So what do? If you look at this slide, the Fed on what's called their dot plot, and I know we talked about this before, but the dot plot is a document the Fed produces once a quarter. It's called the Summary of Economic Projections. And what this is the Fed, each Fed member anonymously indicates where they expect inflation, interest rates, economic growth, and the unemployment rate to be over the next 1 year, the following year, and the long term. So basically, it's just their estimates, but they're very anonymous. What we can glean from this is what the Fed is thinking overall. So what you see here on the boxes at the top, back in March, when the Fed released its dot plot in March, the Fed said by the end of this year, the Fed funds rate, remember that big rate that they use to slow or accelerate the economy? They said by year end, this rate would be at 5.2%. Now the Fed in the June meeting, remember the June they paused, but now they said we're going to pause rates, but end of the year, rates are going to be higher, another 0.5%. So this is what's the hawkish pause. The Fed paused in June, but they're saying we're going to continuously put upward pressure on interest rates. There's many reasons why they did this, and I can't go into too much into the details, but one thing to think about, if the Fed was pausing and the Fed said to the market, you know what, we're going to keep rates lower, the market is going to say, oh, that means you're going to keep rates lower. That means we should start to relax borrowing costs. We should make it cheaper again to borrow money. And the Fed was trying to avoid this. So basically, the Fed said, let's pause rates, keep them steady. But at the same time, we're going to be a higher for longer. We're going to keep rates higher. So that's extremely important for you to think about. So the Fed is pausing. That's kind of good news, right? The concern that we have is that you look at this table. This table, it's got lots of data on here, but the thing to look at is that it looks at today, where we are today, and it looks at the last 4 times the Fed paused. Remember, the Fed pausing is going from raising rates to pausing, to not raising rates. And if you look at things like economic growth, you look at industrial production, you look at other data points, the data today is not as good as it was last time the Fed paused. So our perspective here is that the markets are very optimistic about the Fed pausing or maybe eventually cutting rates, but the market is not pessimistic in terms of why the Fed may likely need to cut rates down the road. That means economic growth is potentially slowing down too fast. Because remember, we talked about this before. It takes about 12 to 15 months for a rate hike by the Fed to be fully felt by the economy. The Fed started raising rates in March of last year. You move the economy ahead 12 to 15 months, maybe 18 months. You're looking at maybe we'll start to feel the effect maybe this fall. Again, the Fed is watching this carefully. And the key thing is the Fed is pausing because the Fed wants to see the impact of all of this on the economy. But again, there's a lot of data here. And let me show you one example, the one I like to look at. This is the middle column, the Senior Loan Officer Survey, percent of tightening. So with the Fed raising interest rates, What this means is the Fed is saying, is trying to slow the economy down. At the same time, though, you have banks who are starting to see less deposits because interest rates are higher and other high yielding investments. So deposits are coming out of banks. So banks are seeing this. At the same time, some banks, those smaller banks, are a little bit worried that maybe a regulator might come in, seeing what happened to those banks in March, and say, let's look at your paperwork, let's look at your loans. So these banks who are seeing deposits come down and worried about increased regulations have started tightening lending standards pretty fast, pretty quickly. This arrow shows examples of lending standards from loan officers at banks, whether it's towards small companies, large companies, industrial loans, commercial loans, residential loans. Lending standards are tightening pretty quickly. This is what we're watching very carefully. We're watching the impact of the Fed raising rates in terms of the overall economy. So our first theme is that the Fed pauses. So the Fed pauses as they did in the June meeting. If you look at the July meeting, the Fed has or will likely raise rates by another 1/4%. But most likely at that point, the Fed keeps rates at the same level for the rest of this year. That's on higher for longer because the Fed can't do what they usually do, start to cut rates, because then that would sort of signal to the rest of the market that, oh, it's okay to lend out money, it's okay for the economy to reaccelerate, and that could create inflation. So I know I went into the weeds, but think about this. The Fed is pausing, slowing down the rate hikes, but likely maintain this higher level for a longer time period. That's the first theme. The second theme is sort of the title of the presentation. The equity market is ahead of itself. So if you think about the economy and the market, there's lots of potential headwinds. You still have some uncertainty around the Fed. We have an election next year. You have economic growth starting to slow down a bit. You've got this uncertainty. The stock market is saying, you know what, we don't care about this. You look at this slide. This slide shows the stock market has had a pretty good run. If you think about from October of last year till now, the stock market's up nearly 20-25%. That's a really good clip. That's a really good performance. And what's driving that is basically, enthusiasm, excitement about the potential China reopen. You've got excitement around AI. You've got excitement around the fact that we had a warmer winter. And in theory, warmer winter reduces what you spend on energy costs. Therefore, if you're spending less on energy costs, therefore, you're likely to spend more money on retail goods. And you saw this in economic data. The data in January was pretty good. The data in February was pretty good. The data in March was okay. The data started to slow down a bit. So long story short, the market has gone ahead of itself because it's pricing in all this good stuff, but not thinking about any type of near-term concerns. If you look at the market, let's look at the market in a different way. This is called market breadth. And market breadth, I'm not talking like bad breath, but like market breadth, like breath here. And what this is that for a market to be, market breadth is basically the number of stocks going up relative to the number of stocks going down in an upwardly rising market. I know it's a lot of stuff there, but what that really means is that basically, if a market's moving higher, you want good market breadth. You want more stocks appreciating within the index. I know we got into the weeds again, but it's important. Basically, market breadth suggests that if a market's rising, you want more stocks taking part in the rally. If you look at this slide shows two lines. The dark line is the S&P 500. Remember, that's this big, broad benchmark that we look at. It's up, 16% since the beginning of the year, through the first half of the year. Look at the light blue line. The light blue line is the S&P 500 equal weighted index. So instead of taking the S&P 500 as it is, what you do instead is you equally weight every single company within the S&P 500. That spread between the two is about 10%. This suggests that biggest companies are driving the market return. So it's not all the companies moving up in the same direction. It's just really those big, large companies which have a bigger weight in our overall index are driving market returns. Here's another slide. The slide shows some of that data in a different way. If you look at the S&P 500, if you take the weight, the allocation to technology stocks, communication services, and consumer discretionary, 3 sectors. Remember, there's 11 sectors in the S&P 500. 3 sectors today are about 47% of the overall index. That means it's a very, very top-heavy index. So if you take this information and the poor market breadth that we see in the market, our perspective is the markets, while they're moving higher, are not exactly a very healthy market. And you combine this with this fact that market valuations are pretty frothy. So I showed this slide to you. I know we spoke last time, but again, let's look at this slide. The slide shows two lines. The light blue line is inflation, CPI, Consumer Price Index. The purple line is the PE ratio of the S&P 500. PE means price to earnings ratio. So price of the stock market divided by earnings. Long story, if it's higher, stocks are more expensive. If it's lower, stocks are cheaper. What you see today is that the PE ratio of the stock market is at 19.5. 19.5. If you look at the 20-year average, it's about 16.4. So today's valuation is a lot higher than its long-term average. That's worrisome. But you can theoretically justify having a higher valuation, a higher PE ratio, if you have lower interest rates and if you have lower inflation. But you look at those red circles. The last time we had a PE ratio around this level, that blue line, that inflation line, was much lower. So this worries us. And valuations are pretty high, and they're pricing in all this potential only good news. And again, we're seeing there's some potential concerns to be watching very carefully. So our second theme is that the equity markets have gotten ahead of themselves, that they're pricing in all good news out there. And if you think about that, you know, what could happen? We think the markets could be volatile, maybe a little bit uncertainty, nothing crazy, but a little bit of a volatile or uncertain period. So go back to our themes. Number one, the Fed is pausing, but likely to remain higher for longer, keeping rates higher for longer. Number two is that the equity markets are really too optimistic and they're pricing in only good news, and maybe a pullback, a slight period of volatility could be on the horizon. Our third theme, though, is more of a positive sign, in that even if we have this market volatility, even if we have a pullback, things are going to get better. We do believe the market is going to set us up for a better late this year or even a better next year. One thing you can look at is this slide. This slide shows upside surprises. So what does this mean? If you think about investing 101, you know, investors like it when the economy is stronger than expected, because if the economy is stronger than expected, companies sell more stuff, they sell more goods. If they sell more goods, they generate more earnings. If they generate more earnings, investors get attracted to the shares of those companies. Makes sense, right? So again, investors like it when the economy is performing better than anticipated. If you look at this slide is an index from Citigroup, and this is called the Citi Economic Surprise Index. So every time a data point comes in above expectations, the line moves higher. Every time it misses expectations, the line moves lower. So we anticipated at the beginning of this year that upside surprises would happen late this year, because basically we'd have all this pessimism, that the uncertainty that the economy would be weak, the stock market would not be happy. But what we saw actually was that upside surprises happened much faster than anticipated. And really, as I talked about before, what was it? It was the January effect that we saw a warmer winter. People spent less money on fuel. We saw the China reopen excitement around there, AI fever. And then think about this, natural gas prices fell dramatically. So Europe, which depends heavily on natural gas, Europe actually avoided a recession that was highly anticipated at the beginning of the year. All this together created this economic data that came in above expectations. But more importantly, though, you look at what's been coming in better than expectations, is this data that has been out of favor for a while. So we talked about this maybe the last time or the time before. We said that in 2023, if we have a recession, the recession would be mild. And one thing we point to is what we call a rolling recession. So in a nutshell, we felt that if we have a recession, it's not going to be a sharp, nasty, ugly recession like we saw in 2008, which hurt everything. We envisioned a recession that rolls through the economy, hitting sector by sector by sector, a very shallow, a very mild recession. And in this type of rolling recession, we told you that three things are in recession right now: housing, autos, and manufacturing. What's not in recession? Consumer spending, leisure spending. People are flying, people are going to hotels, people are going to bars and restaurants, all that stuff. So again, manufacturing and autos and homes are in recession, and what's not is consumer spending. Right now, though, those areas that are in recession are now starting to stabilize a bit. They're coming in a little bit better than anticipated. You look at this slide. On the right hand, this slide shows new home sales. And you look on the right hand side, that little uptick. Home sales are picking up. We saw home prices and home sales drop dramatically. You see that line going down. Now it's starting to stabilize. Again, what was in recession before is now starting to recover. Another area, auto sales. Auto sales were struggling, but now if you look at these purple bars, this is month by month by month auto sales, and you see a slight trend. More importantly, look at the light blue line. The light blue line is a 6-month trailing number, and that light blue line is moving at a nice clip. Auto sales, which were in recession, are starting to improve. The other area that's been in a recession, we've talked about this a lot, is manufacturing, because we all bought everything we needed back during the COVID recession, TVs and TVs and refrigerators. And then basically after COVID recession, manufacturing slowed down dramatically. But now you look at this slide, and manufacturing is in a recession. But you look at this slide now, there's been a huge, huge jump in spending for manufacturing facilities. So whether it's from the CHIPS Act, whether it's from electric vehicle production, whether it's from batteries, there's been a huge spending on manufacturing. Again, another sign that an area of the economy that was in recession is starting to improve. So overall, we do believe the data is starting to come in a little bit better than anticipated. Again, upside surprises in the economy are happening faster than was originally anticipated. And then overall, this is something we've talked about before, the job market is pretty strong. So even if we have a near-term market volatility or near-term uncertainty in the economy, long-term, the job market is extremely strong. We can look at the job market in many ways, like the unemployment rate, the number of payroll jobs. We can look at, temporary hiring. Look at jobless claims. Here's my favorite. This is simple. This is basically the number of job openings relative to each person looking for a job. We were at about 2, so 2 jobs for everyone looking for a job. Now we're about 1.6. It's come down, but the good news is it's still very, very elevated. There's so many jobs, and we are confident there's a job out there. This should help provide a buffer to spending. Good news there. So overall, the economy is in good shape. The economy is it's not great, but it's okay. Okay. And the data is starting to get better. And again, as we mentioned before, if we had a recession, we continue to feel it would be mild. It'll be a rolling recession. Good news, we may be skirting a near-term recession. We'll see. I think it takes, as I mentioned before, 13 to 15 months for the economy to feel the impact of rate hikes. And if you had that strong January of this year in terms of the economy, and you kind of push the data a little bit forward, maybe we might have a recession late this year, early next year. But regardless, if we have a recession, expect it to be extremely mild. The other part about the investing story is earnings, corporate earnings. Remember, earnings drive stock prices. And earnings we're watching very carefully. I think what's good about earnings right now is that profit margins, while they're starting to come down a little bit because you have high labor costs, you have high interest rates, high borrowing costs. But the good news is that if you look at this chart plots 2 data points. The light blue line is PPI, the producer price index, and the purple line is the consumer price index. And we've talked about that already a few times. If you think about that, this is producer price index is sort of business costs. Consumer price index is sort of what businesses can sell stuff for. And what you see is that business costs, as measured by PPI, are falling at a faster rate than consumer costs. All this means is that it's just some protection possibly for profit margins. We're watching this very carefully, but it's a good sign. I think overall, as I talked about before, earnings are so very strong. I mean, it's strong in terms of where the stock market is likely headed. And earnings for this quarter, we just had the second quarter. So now we're in the second quarter earnings season. Earnings are expected to decline year over year about 5, 6, 7%. And then next quarter, maybe flat to maybe up 1%. But then you go ahead to the fourth quarter, to first quarter of next year, to the second quarter of next year. Earnings look pretty strong. So our point here is that even if we have a market pullback, even if we have uncertainty around the economy and the market, investors are going to start looking at earnings on a go-forward basis and get excited about these numbers, these year-over-year numbers, especially as they start to appear early next year. Good news there. So as I mentioned before, 3 themes. The Fed pauses, but likely higher for longer. Number 2 is that equity markets have maybe gotten a little bit ahead of themselves, pricing in too much optimism. And the third point is that Even if we have a pullback, we have volatility, we do believe we're bracing ourselves for a good late this year or early next year. So what does this mean to you? As I've talked to you about this before, two things. Number one, be diversified. Diversification is so important. You look at right now, this year, growth has crushed every other major asset class. Growth has crushed value. If you look at from a size standpoint, mega cap has beat large cap has beat mid caps, mid cap has beat small cap. All this together is really, you have to be in a narrow part of the market to have done very well. So when you have situations like this, you may say, well, why be diversified? Why have exposure to different parts of the market? Diversification is a key investment strategy. It's allocating your money to different parts of the market. Continue to look at diversification. You look at this slide. This slide shows, remember those PE ratios, price earnings ratio? Higher is more expensive, lower is cheaper. That dark purple line on the top, that's a PE ratio for large cap growth stocks. Those other lines, those ones a lot lower, those are the PE ratios of other asset classes like large cap value, like small cap, like mid cap, like non-US. There's some opportunities to be diversified to exposure to not just to the least expensive parts of the market. That's the first thing, be diversified. Number two is stay in contact with your advisor. They need to make sure that your portfolio is diversified and in line with your objective. Not too aggressive, not too conservative. This means stay in contact with them, keep them updated. Make sure that you're in constant communication with them because they need to make sure that your portfolio is perfectly aligned with your long-term objective. So with this said, I just want to thank you so much. If you want to follow us on Twitter, we're at Cetera IM. You can follow me on Twitter at Gene Goldman. Thank you so much for listening and looking forward to talking to you next quarter. Thanks again and make it a great day.